Hey guys, in this video I want to share 2 tips on how your family can avoid paying taxes legally. My family was paying about $13,000 in taxes just a few years ago. For the 2018 tax year, we ended up paying 0 federal income taxes. Now, to add some context to my family's financial situation, we earn just below the area median income for our neighborhood. My wife is a stay-at-home mom. I work as a strategy analyst in the financial industry. I'm not an attorney or a doctor or a highly paid professional in any way. We don't have $1 million inheritance. We don't have an account stashed away in the Cayman Islands or anything like that. We're just an average family of 4, soon to be 5. I've been wanting to make a video on taxes for a while because it's such a big part of our financial lives that we don't really talk about very frequently. And I'm passionate about helping moms and dads be smarter about their family's finances. And being smart about taxes is going to pay off tremendously. Now, if you're new here, my name is Sung and this is Grow the Piggy Bank, where we talk about how to grow your family's wealth and achieve financial independence. If these are topics that might interest you, please hit that subscribe button down in the description below and make sure to hit that notification bell so that you don't miss out on any new videos. You can also check out my other videos on how my family saved 40% of our income on one income, as well as some great saving strategies that your family could implement. So I'll link those videos in the description down below. There's a bunch of taxes that we all pay, but for this video, I want to focus specifically on the federal income tax, because that's one of the biggest tax burdens that families have. As a disclaimer, I'm not a tax attorney or a CPA. This video is purely for educational purposes, and I'm sharing from my own personal experience and in my own personal situation. I recommend you do your own research and you talk to a tax advisor or a financial professional before you make any type of tax decisions. That being said, if you have any questions or you want to share any type of tax strategies that has worked really well for you, please leave it in the comments below. Before we dive in, I want to share the core principle that underlies my 2 tips, because if you understand the core principle, then you can apply to your own personal situation as applicable and take advantage of the opportunities that are before you. So what I've learned from researching and reading about financial independence and how wealthy people pay so little in taxes is the fact that the IRS broadly categorizes income into 3 types for tax purposes. There's earned income, investment income, and passive income. Now, for this video and in the context of taxes, when we say passive income, we're talking about the IRS's definition of passive income in light of taxation, not necessarily the popularized form of passive income, such as affiliate marketing or like online course creation, YouTubing or blogging or stuff like that. We're talking specifically about passive income as the IRS has defined it. Now, that passive income is a bit complicated, and I recommend just doing your own research to figure out what exactly would fall under passive income. But 2 of the most popular forms of passive income that the IRS recognizes is rental property investing and or royalties and patents. Now, the IRS defined passive income is probably the most advantageous type of income. Investment or portfolio income probably comes a close second, and the worst type of income to have from a taxation perspective is earned income. Now, there's 3 reasons why earned income is the worst income type to grow your wealth. First is earned income has some of the highest tax brackets. Second thing is you can't really avoid payroll taxes, so that automatically takes away 7%, 7.5% of your income that you earn. And thirdly, there's not a lot of flexibility to avoid taxes. Whereas for passive income and investment income, you have a lot of control in how you can avoid or defer taxes. That leads me to tip number 1, which is to get more of your income from passive and investment income sources than earned income. One of the best passive income sources that you can get is a rental property. My family recently purchased several rental properties, and they've been a game changer for our taxes. The biggest reason is being able to use depreciation to help us offset our other income. Now, depreciation is known as a paper loss or a phantom expense because it's not something that actually pay for, but it's something that the IRS recognizes as a cost of holding an asset. Now, there are a number of rules around it, but if you qualify, you can use depreciation and shelter some of your earned income, similar to like an IRA. Except, unlike an IRA, you don't have to move your money around anywhere or have it locked up in some kind of account. Now, in addition to passive income, I also want to talk a little bit about investment income and why you want to get more investment income. We're going to quickly jump to the screen and I want to show you two different tax brackets. That's going to be a really good example for why you want to get more investment income compared to earned income. So the one on the left here is the earned income tax bracket, and the one on the right is the capital gains tax bracket, also the investment income tax bracket. So basically the gains you get from investments. Right off the bat, you notice how the tax rates for earned income are much higher than the capital gains tax rates. Earned income can go up to as high as 37%, but the highest capital gains tax rate is only 20%. Now, if you look closer, it gets even better for investment income because if you compare the tax brackets, you'll notice that for earned income, you pay taxes on the first dollar you earn at 10% on earned income up to $19,000 for married filing jointly and $9,700 for single filers. But if you look at the capital gains table, you'll notice that the tax rate is zero for close to $79,000 in capital gains for married filing jointly and $39,000 for single filers. That means that if you filed jointly and only lived off of investment income, you don't have to pay any taxes as long as you don't realize more than $78,000 in gains. So like you, I was wondering exactly how much more you would pay in taxes when you make $78,000 in earned income versus paying zero for investment income. So I did the math quick on this other spreadsheet here, and based on our simple example, if you earn that amount, your taxes would be more than $11,000. But sadly, we're not done yet because we have to consider payroll taxes. Now, if you have payroll taxes, that only applies to earned income, not investment income. So if we include FICA tax, which is also different wording for payroll taxes, if that's 7.5%, which is the usual, then you're paying a whopping $17,000 in taxes, and that's still not even including state or local income taxes. But I think you get the point that basically earned income sucks. It really sucks. So you can obviously see how it's going to be much more advantageous to make money through investment incomes or passive incomes. If you're finding this video helpful in any way, please hit that thumbs up button down in the description below. Tip number 2 is if you don't have passive income and you don't have investment income and all you have is earned income, then you want to start reducing your taxable income immediately. You can try to minimize taxes on your earned income by deferring or avoiding taxes. Now you can defer your taxable income by opening up a traditional IRA or contributing to your employer's 401k. By transferring your money into one of those tax advantage accounts now, you're basically minimizing your taxable income and therefore you're going to pay less taxes now. You will still pay taxes when you withdraw the money out of the accounts down the line, but you can't predict what's the tax rate's going to be when you do withdraw it, and you don't know how the rules will change. So I'm a big fan of taking the tax advantages now because you know 100% certain that you're going to be able to avoid taxes now. Then strategize to lower your future taxes when you're close to the time in which you're going to withdraw it, because the rules will be more certain and you will be a little bit more aware of what you can do to lower your taxes at that time in the future. Also, by using a tax deferred account instead of a Roth or a post-tax account, you're able to leverage something called a Roth conversion ladder. It's a strategy that will let you tap your pre-tax accounts without penalty much earlier than your normal retirement age of 59 and a half. And so this is a very complicated strategy, but I will make another video at some point in the future about it. Now, you can also avoid taxes on your earned income by using something called a health savings account, also known as an HSA. The HSA is an amazing tool that is available to you if you have a high deductible health insurance plan. It's basically a savings account and an investment account lumped into one, and it's meant for medical expenses, but it's got some amazing tax benefits. Most importantly, it's got 3 tax benefits that you rarely find in the tax code. First, the contributions are tax-free. If you're a family, you can contribute up to $7,000 into an HSA. If you're single, you can contribute up to $3,500. So that contribution will directly lower your taxable income. Secondly, the growth is tax-free. So you can take that money in your HSA and invest it into a low-cost index fund or an ETF. And as that index fund and as the value of your account increases and appreciates, none of that is going to be taxed. Thirdly, the distributions are tax-free for qualified medical expenses. So if you have any type of medical emergencies or you have any kind of health issues, you can use the money and tap into the account anytime you want. You will never lose the money and you will never have to forfeit the money in any way. That's all I have for you guys. If you like this video, please give me a thumbs up and make sure to hit that subscribe button down below for all new videos. And if you enjoyed this video, be sure to share it with any friends.